YouTube, it's Dimitri, and today we're going to talk a little bit about the banking industry. We're going to talk a little bit about the regulations. We're going to talk a little bit about machine learning. This all comes up, one of my subscribers, followers on LinkedIn and connections. His name is Kashan. That's how you pronounce it. I'm sorry if it's mispronounced. But one of these things is like talking about machine learning, and like students, for example, are really, really excited about it. And if you come from the tech industry, a lot of times you're like super motivated and you're exciting and you're running all over the place and you're getting all this stuff done. And like, I think it's a little misplaced in the banking world. And I think understanding why this occurs and understanding some of these issues might help you understand the realm of banking a little bit better and how it's so much different than a lot of other areas. So first off, when you get into the banking world, when you come out of school, a lot of times you're really excited and you want to get a lot of stuff done. I get it. Like, I completely get it. I've been in that boat. I wanted to do that. But what happens is you realize in the banking world is there's red tape everywhere. So essentially you're like in this little box and you can see outside of the box, like a glass box, and you can see everything. But the issue is that it's hard to figure out how do you do things inside the box without getting out of the box. And so some of these examples here is like regulatory concerns. So when you have things like CCAR, for example, some of these requirements behind these models for CCAR and DFAST is that things have to make sense and they have to understand the model. So you have to know, for example, when GDP increases, if that's in your model, and if like the 10-year interest rates in your model, if these increase or decrease by X amount, what happens to your output? So a good example of this is like mortgage LGD, so loss given default on a mortgage. This is part of the expected loss formula. You can Google it, but its expected loss is equal to PD times LGD times EAD, which is probability of default times loss given default times exposure at default. Standard equation, everyone uses it, but you model each piece and then you have to incorporate inside of these time series and macroeconomic variables. So when you do this, you have to understand how A affects B. So you can't do a machine learning method without some understanding of what's going on. So I've been working a little bit in neural networks. I think you can actually explain this somewhat by breaking down the weights and then trying to figure out how the weights impact it. So if you have a one-layer neural network, it's a little easier because you see, okay, things come in, they have specific weights. Things go out, they have specific weights. And then you can try to break these down into intuitive parts, but it's a little challenging. But it makes sense, right? Because if you say like GDP is going to go up by 50% and then this black box of a neural network generates some crazy result that makes no sense, right? It's hard to explain. It's like, what's the point of even making the model? The whole point of the model is to understand dynamics between your inputs and your outputs, and then trying to get a realistic expectation of what's going to occur given the Fed's scenarios they give you. So that's one piece. There's a whole list of rules and regulations. Like, you can't just build models and say, oh, accuracy's R squared is like 99%. And it's great and it's wonderful. That's not how it works in banking. It leads me kind of to my second point here, which is money. So in the tech world, I think, and even in student world, and even like in other industries, I worked in manufacturing for a while. When you have mistakes, a lot of times your mistakes cost you small amounts. So $5, $10, $15, $20,000. And those might be over a long period of time. But that being said, these costs are actually getting larger and larger in other industries. And for example, Facebook and their whole data scandal, the fact is that this is costing a company probably millions of dollars because it's reputational damage. People are now concerned about using Facebook. They could be sued for this. Like, there's a lot of implications in this. But when you come to the banking industry, it's so highly regulated to protect consumers. So banks have to do, whether it be an investment bank or like a traditional bank, like a residential commercial banking, you have to protect your clients. That's the job. You're there to provide financial services to these clients. And so, for example, banks do pricing. They give you a loan and they price you. There's a couple implications on this. One, if a company misprices a bunch of people and the expected loss that they have versus the income they have, right? If this is wrong, you can lose millions of dollars like that. Like overnight, things are just gone. Like you make all these loans, you wait 6 months or something, you didn't do it right, and all of a sudden, all these people start defaulting, and your model didn't pick that up correctly, so you mispriced them. When an economic downturn happens, right, even if you think you price them correctly in that current setting, time changes, and when the crises hit, you can lose vast amounts of money. You lose millions of dollars. And so when you think about this, right, in my last video here, when I talked to my buddy Noel, as he worked as a derivatives FX trader, he talked about like his advice is be perfect. Like in finance, you have to be perfect because there's tons and tons and tons of money on the line. And he talked about in his scenario, he made a mistake during his job doing trading. And his biggest one was like $50,000, $60,000. Just gone, right? It's just gone. 50, 60 grand gone. And it's every single day though. So these can add up and you can lose a lot of money if things don't go right. And I think this is where like hedge funds and stuff are very good in the fact that they focus in on strategies, and some of the big ones like Citadel and Two Sigmas and even like Bridgewater, they've done really well at managing it and they haven't blown up. But there are lots and lots of little funds that think they're going to go out there and make a lot of money, convince people to give them money, build models, model blows up, they lose everything. And so I think this is an aspect of banking where it's like you have consumer protection on one side, which is you have to make sure you're pricing them fairly. And there's a whole set of regulations behind that. There's like all these things you can't do for discriminatory purposes, which makes sense. There's a whole list of things that you have to prove. Like if somebody needs to understand why they're being priced the way they're priced, you have to explain that. So you can't go in here and say like, oh, there's this model we have and it kind of prices you. And then, I don't know, that's just what you get, right? Banking industry, the protection agencies don't care. They have to know exactly how you price them. And I've actually had a manager who told me at one of the banks, somebody complained and they actually found out there was a mistake in the model. So the general theory of the model made sense. It went through regulations, went through internal audit, validation, all that, and it passed and it made sense. But there was a subpopulation within the data, again, that they didn't catch, and those are being mispriced, and that ends up in lawsuits, and then banks lose millions of dollars because these lawsuits are huge. It's not like, oh, $50,000 reward. You know, it could be millions of dollars. It could be class action lawsuits. It's huge. So you have the Consumer Protection Agency on one hand. You have pricing accuracy, as you mentioned before. So like you could lose a bunch of money because you don't have you just did it wrong, or the market's turned and you didn't model it correctly. So even though you had a model and you thought it was correct, it wasn't correct. It wasn't robust enough. It didn't have all the dynamics in it. And so therefore you lost a lot of money. And then you have PII, which is personal identifiable information, or PI is personal information. Banks have all this information on you. They have like your social security number, they have like your income, they have your address, they have your phone number, they have all this information on you to make the loan, which is okay. Most model developers don't get data with most data in it. So I, for example, have never seen data with social security numbers in it. Why? Because it's a huge security risk. Like I don't need those. I don't need to know what your social security number is. The bank might need to know it to verify the loan and who it's going to, and make sure it's not like a criminal act and all this other stuff. But on the flip side, right, that's a risk banks have to take. And so there's all these layers of like, how do you process data? Right, the data I'm getting, who processes that? What procedures are in place to prevent that? And that's more red tape. So you have to have those layers and protections in place. And then when it comes down to it, you have technologies, right? So when we're throwing data into models and developing them, one of the big scares is like open source. So the banks I've worked at, I don't even know any bank that uses cloud technology here. Like for example, Amazon Cloud. And the reason is that the data has to be secured, it has to be protected, it has to be prevented from hackers. And so there's a whole IT security department that handles all of that. So when you start layering these in, right, you're thinking like, oh, this doesn't apply to me, I'm a model developer, but it does. It prevents what you can and can't do. It prevents which tools you can and can't do. And then banks like to be consistent across the bank, which means everybody should be using the same software. So that puts more restrictions on where you're at. So you might be in a project thinking like, oh, I'm going to do a neural network. Oh, but by the way, SAS is the one that almost all the banks use. So at that point, then you're like, all right, well, I can't do it in SAS, or I have to program it. So should I program it? Should I do it in another language? And then a lot of times you have restrictions in place like, oh, you can't use these software. So for example, on a lot of IT security, it's hard to download things. Like when I'm working in R, I can't download library packages, right? I have to go through IT. I have to request it. It can take a few weeks to get it. Then you finally get what you need. And sometimes you're rejected saying that you don't need these things. So you have that layer of red tape on top of it. And so really, really good managers in the banking world are those that are really good at actually removing all these hurdles we have, helping define clear paths. I've had managers that have laid out very, very clear ways of avoiding working with personal information, making sure everything's processed, clean, goes through the right channels, all before this happens. So this is important in banking because there's regulation on top of regulation on top of regulation. So all your personal information is protected. It has all these laws and regulations. We have legal departments, we have IT, we have model governance, we have governance departments, we have all these people that are involved. And so in banking, you have all these things you have to deal with. And so a lot of people say oh, I'm going to jump in and I'm going to get stuff done and I'm going to do machine learning. And I'm excited for it because I think it can add some value in some places. But I think on the flip side of that, right, you have to realize there's a lot of regulation in place. There's a lot of things you have to make sense of, and there's specific guidelines you have to follow, because if not, banks will be sued for millions and millions and millions of dollars. Wells Fargo is a great example. They've been having all kinds of lawsuits because of, employee practices and trying to make extra money and all that stuff. And again, that all comes back down to even in the modeling sector and how products are sold and how you detect this. But just to kind of lay this on top and kind of wrap this up a little more, machine learning has been used frequently in fraud detection. It's been working great. I've heard people say it does amazing things. It's a better modeling method. That being said, I think one of the big things to kind of drive home to students specifically and even senior management, those that aren't working hands-on every single day with machine learning and with statistical models, you have to realize machine learning can only solve specific problems. So I hear things I'm not going to say who, but I had this really great connection I was working with, and we were talking about time series and going through this, and they're like, oh, Dimitri, machine learning is the future. It's going to take over all of this. We're not even going to need to know time series. And I started looking at them and realizing okay, well, banking, you have to have regulations, you have to have causality, you have to explain the model, right? The regulators have to approve of your methods. So it's there's all these things you still have to do. I think people are delusioned. If you think machine learning is going to take over statistics, you got a rough road ahead of you, because machine learning does really, really well in specific areas, but it does really, really poor in other areas. And I've talked to some of my colleagues at other banks that are actually using machine learning, have been using it for 4 or 5 years now. And they're saying oh, when we do this, it's amazing. It outdoes logistic regression, it outdoes OLS, outdoes ARIMA for these specific areas. It's great. But we've tried doing this area, and either the regulations prevent us from building machine learning models, or it just doesn't do that well of a job. And the reason being is that neural networks, for example, does a great job in nonlinear spaces, but it doesn't do a very good job when you do a linear space, and it adds additional complexity that you don't need in a model. And then kind of following up with this, in this email I have on LinkedIn, they wanted to know more about is this being done internally? And the thing is yes and no. I think a lot of the analyst levels, the people doing all the grunt work, a lot of us are super excited about machine learning. We're statisticians, financial engineers, right? So we're already diving into this. We already want to do this in our free time. Just like my channel here, right? I'm doing a lot of machine learning because I want to do it. I'm not doing it because I'm being told to do it. I'm doing it because I want to do it. I think a lot of banks too, something else to mention is that we're always busy. We always have things we need to get done. So a lot of times we don't have time to look up and think, okay, what are we going to need in 5 years from now? What are we going to need in a year from now? Let's set time aside to do machine learning. Let's set time aside to do X, Y, and Z. A lot of times our heads are down and we're just grinding out our work every single day because that's what we're being paid to do. But yes, there are people that are working on the machine learning side. Do I think it's going to take over and risk management and banking is going to be this realm of machine learning? No, I don't think so. One of the biggest reasons, as I mentioned, is all these regulation, all this red tape. Banks spend a ton of money on doing this. And it's one of those barriers that actually I think prevents fintech from getting into the banking realm, because they can't afford to meet all the requirements and have as many staff members and employees as they need to cover it. And so it's this huge barrier to enter. You have to have all this staff, all the knowledge, all this money to pay them just to be able to meet the requirements. And it's super, super expensive. CCARs cost banks millions and millions of dollars every single year. So thinking that like it's all going to switch overnight. No, I don't think so. Do I think machine learning is going to take over the world and be the greatest and best thing? We're going to automate all these jobs away from model development? No, I don't think so. I've seen a lot of banks struggle today building basic models and passing validation, internal audits. So the fact that you think you're going to go from somehow not being able to build basic models to automating to having amazing results, I just can't see it. It's possible. It's definitely possible, but it's another 10, 20 years out. The tech world is still like getting their hands dirty. You know, Google's doing lots of cool things with it, but banks are so much further behind. There's so much more regulation, and tech does not have nearly the regulation as banking. I don't know if I agree or disagree with that, if it should be increased or decreased on either side, but at the end of the day, there's just a lot of red tape. There's a lot of things that you can and can't do. So in general, I think it will be beneficial, but from the banks I've seen, most of them don't hire data scientists. They're not hiring machine learning experts. They're hiring statisticians, financial engineers, and the likes. I think it's important to learn machine learning. I think it is going to, I'm not going to say take over, but it's going to add another layer of modeling and development. I know some people think that it's going to automate all this stuff away. These people I think are kind of funny because I just don't see it happening anytime soon, especially at the level required not to lose money in a bank in a trading setting. But I do step back and say Citadel and, you know, Two Sigmas and a bunch of these hedge funds that have been around for a while and have implemented some of these techniques, they've done very well. They also bring in the best and the brightest, and they have very focused teams that focus just on this. And they have, again, probably all these staff that are related to regulations, meeting all these requirements. But that's kind of my take on the machine learning part. Anyways, thanks for watching. Don't forget to like, share, and subscribe. And as always, until next time.